Powell sent stocks, and specifically financial stocks, into a tailspin last week when he didn't say exactly what the market wanted him to after cutting rates.
However, we think that's wrong, and we are going to see rate cuts that continue over the next year, maybe even year and a half, not just in the current quarter, and what that means for the stock market, and a couple of really interesting stocks that you may want to get ahead of.
Find out more today, including 2 stocks we think can benefit a lot from this on today's Altimetry Authority.
Stock earnings and favorite pastime.
Let me just say, earnings
liquidity
why
of Wall Street.
It's
It's
why do they
2.5x.
Because their compensation goes up.
Wall Street's wrong again.
Well, the market didn't seem to much care for Powell giving them the news that they wanted to hear, basically last week, which was that we are cutting rates. So everybody, as you know, we are in our second step of the rate cut cycle that started in September. First time we cut rates since late last year. And yet, for anybody who was paying attention last week when Powell cut rates, the market's response was less than positive. And the reason why the market's response was less than positive, everybody, was even though we are now on the way to this rate cut cycle, Powell also said something else important, which he said he is telling everybody to not be so confident that we're going to have another rate cut in December. And so what he basically said is, hey, look, we can see that what's going on is we see what's going on with inflation, we see what's going on with employment, but we're going to have to wait. And everybody panicked, right? I mean, I don't know if Joel, I don't know if you noticed, but literally I remember the day of, I happened to look over at the screen after Powell came in his press conference, and there were a bunch of financials that were down like 5, 6, 7, 8, 9% down, right? And everybody, the reason why was because people were changing expectations about rate cuts. But anybody, Joel, who's changing their perspective on rate cuts is really missing one important thread, which is to listen to the guy who's going to appoint the next Fed governor. The next Fed chair, I should say, which is Trump. And Trump is saying that whatever Powell thinks about where interest rates should be, everybody, in December, he knows where he thinks interest rates should be. And he thinks interest rates should be decidedly lower than they are now. And where this is just for everybody, the Fed funds rate and where it has been for the last, call it 4 or 5 years, and where Trump thinks it should be. And here's the thing, right? Powell has made his noise in terms of saying, hey, that, things are going in the right direction and everything else. But, we have to wait and see. But we think that that's caused the market to miss a thread. And here's why we think the market's going to miss a thread. Go, Joel, yeah?
Hey, Rob, the issue is because we run cognitive analysis, and we always do on the Fed. We actually run on every CEO of every earnings call of any stock that we look at. We also run on the Fed. And it was clear for a year that Powell really had a tariff fear that would jump whenever he talked about inflation, that he would keep saying he assumed, and we think incorrectly so, I don't think that he had the right math on this. We don't think, we're sure he didn't have the right math on it because we saw what happened. Tariffs did not result in widespread inflation. He thought it was going to do rampant inflation and was ahead of his belief that would cause high inflation. He was keeping rates at a high level for a much longer period of time. And at this point, whatever you think of the Trump administration, at least directionally, the Trump administration was correct. Unemployment is truly a bigger issue, and now we're seeing the data show that, is a bigger issue than the threat of inflation, and tariffs do not result in direct inflation the way that Powell had been afraid of. And it seems like he's intimating that he says, look, I am cutting rates, but I'm still worried about inflation coming from tariffs. I would argue incorrectly so. The history of the last 3 quarters would say incorrectly so. Now, I'm not saying that the proper rate should be as low as Trump is suggesting, as he's suggesting getting to that range that we've been looking at of something like 2% or 2.5%, but something less than where it is the right direction to keep the economy healthy. The stock market is reacting because I think people thought that Powell was going to be in a deeper rate cut cycle, and him even saying, maybe not, don't get excited, because if we do see inflation popping its head up, I'm going to stop cutting rates, as we see that. But our belief is that he's still going to see unemployment being a bigger issue than inflation, and he'll probably still have to cut rates at least another quarter point, if not another 50 basis points over the next 6 months. That said, as you're saying, Rob, Powell's done by May, and by May there'll be someone new in the Fed that will be appointed by Trump, and when that happens, we're likely to see an increase in rate cuts, meaning more rate cuts, if Powell doesn't deliver them in the next 6 months. Either way, those are very, very, very bullish signs for the U.S. stock market, regardless of what happened in the last week.
And so for everybody, for context in terms of what happened in the next week, we're actually going to show you some interesting data that we always love to look at. This is the Fed Watch data from CME. And what CME does is, right, CME, the most liquid market in the world for Fed futures, right, for basically where everybody thinks that the Fed funds rate is going to be in the future. And so what they actually disclose is they disclose this tool that basically shows you where the path in terms of what the market is betting is the probability that the Fed fund rate is going to be at any given point in time in the future. And so, right, before the rate cut happened, before Powell came at the end of October and cut rates, here's where rates were. They're at 400 to 425 basis points. And so ahead of the announcement, basically everybody said that there was a 97% chance that we were going to see interest rates get cut by 25 basis points at the end of October. Shockingly, the market was right? Basically, that everybody said, hey, there was a 95 plus percent, basically a near certainty that we would. Then what the market was also saying was that in December, that there was a 96% chance that we were going to see the Fed funds rates go down another 25 basis points to between 350 to 375 basis points. And then what the market was basically saying at the time, this is before Powell's press conference, the market was saying, and there's a coin flip that it's between 325 basis points or 375 basis points in January. Right? The Fed funds rate market, they quote in basis points, right? For those of you who don't know, right, 325 basis points is 3.25%. A basis point is just 1/100th of a percent. And then, but what the market was saying is basically, hey, look, but we know that what's going to happen is by the middle of next year, by September, October of next year, we're going to be down at 275 to 300 basis points. We are going to be at a rate cut. We will be in the midst of a rate cut cycle, and then we will have basically cut 150 basis points. Well, when Powell came in his press conference and said, hey, don't be so confident we're cutting rates in December, here's what happened to that chart. So notice here we're at basically everybody is zeroing in by the end of this theoretical rate cut cycle that we're going to be at 275 to 300 basis points. Now, this is after that, we're now at 300 to 325 basis points. So the reason why all the financials got whacked, everybody, is because everybody basically said, oh, we have to take all of this off the table. And specifically that's because here's where the odds were for the next two meetings in terms of where rate cuts were going to be back in before the press conference, right? Absolute certainty we're going to get a rate cut in December, and a coin flip that we're going to get a rate cut in January. Now we're at 3/4 chance that we're going to get a rate cut in December, and a quarter chance that we're going to actually not get a rate cut, and we're basically at odds on that we probably won't get another rate cut in January. So this is the whole entire distinction here. And that caused the market to just whack all these financials. But to us, we come back to a date that Joel just mentioned before I went through this. We come back to May of next year. You want to know what Powell making all the statements that he just made does? It dramatically increases the probability that Trump is going to appoint another Fed chair in May who will be more dovish, and which means we are likely to get closer and closer to Trump's desired rate, which is between 1% and 2%, not 3 to 3.25% in a real rate cut cycle. And all that, everybody says, hey, for the financials that got whacked, be bullish, right? Don't be running for the hills from them. And the reason why is, look, as Joel, as you said, just to really quickly fly through this, right? We look at inflation. Inflation is not at 3%. If we look, everybody, at more real-time, kind of more broader basis points of inflation like Trueflation gives us, right? Trueflation is saying that we're not at 3%, which is what the BLS is saying. We're like 2.4%. And on the flip side, when we talk about unemployment, all the statistics you look at for unemployment do show that unemployment is rising, and especially unemployment is rising for young people, in terms of people who are just entering the workforce, people who also, for what it's worth, when you talk about geopolitical risk, who create geopolitical risk, we are seeing rising unemployment rates for some of the jobs that used to be the best jobs out there for people to be able to have. For young people, we're seeing if they want to go into finance, the rate at which those people are seeing unemployment and finding it hard to get a job has increased 60%. For professional technical services like coding and everything, 120%, etc. So we're seeing real signs of jumps in terms of rally, which all of that makes sense for why it is that the Fed should be, quite frankly, cutting rates like Trump is calling for, contrary to Powell saying, maybe let's wait and see. But Joel, you and I were talking, and one of the things that we thought of is, this idea of why we should be cutting rates because of risks in the real economy, while at the same time there's something huge going on the sideline that's powering the market, made us remember another time, true or false, Joel, that we can go back to. Right? I mean, everybody, what this does, you'll never guess, for those of you who've been watching the show for a while, it made us think of the 1990s. And specifically, it made us think of, let's just take a journey back to 1998. So in 1997, the Asian financial crisis was in full bloom, basically hitting all of the Asian region, all of the Asian tigers. And yet, basically, as that was happening, nobody really was worried in the US or in Europe, because the fact they were saying, hey, you know what, that's Asia. It's an isolated thing. And we're the economies that power the world. Until in January, it started to impact Europe, right? And yet, what happened? Greenspan comes out in February as everybody's saying, hey, we're starting to see noise here that there's a little bit of nervousness about, the economy. Greenspan goes, look, no dice. We are not cutting rates because the U.S. economy is too strong. Much, by the way, like Powell said at the beginning of this year, everyone, when Powell was saying, look, we got to give time because the U.S. economy is really good. We shouldn't cut rates. As the Trump administration is waving, as Bessent and everybody else is saying, hey, we actually think there's a real issue here. So Greenspan says no cuts. And then what happens, everybody, is towards the end of the year, right, contagion starts to spread, right? You get the Russian ruble devaluation and Russia defaults on its debts. And we had a pretty dramatic drop in the market, right? Still, the Fed doesn't do anything, right? The Fed doesn't do anything, of course, until often happens in the United States, until it comes actually home to roost. Long-term capital management on September 23rd collapsed. And finally, you know what? Guess what? Greenspan said, okay, we're going to cut rates. We're going to cut rates. And so we cut rates 25 basis points in September as everybody's worried, hey, look, there's some real issues going on here. And so we cut rates, right? But what happens? The market says that's not enough, and the market tumbles again. So the Fed, 17 days after it cuts rates the first time, cuts rates a second time. Not dissimilar, by the way, to how we basically in the last month have cut rates 50 basis points pretty quickly because of the fact that we're finally embracing there's some issues in terms of for employment here. Well, guess what? All that, in the midst of all that bad news before the Fed started getting aggressive led to a 35% pullback in the market, right? In basically the span of 3 months. 3 months, 35% pullback. And so you look at that, and so, when everybody says, hey, look, in a bull market, you don't get bad pullbacks like that. Well, we did, and the Fed had to take action because they were worried about something that was going on impacting potentially the real economy. But something was happening, everybody, underneath all that. That something was a massive amount of investment was going in from the U.S. technology, from U.S. technology innovation, right? We were getting a tech adoption innovation cycle, an investment cycle that was fueling the U.S. economy. What this is private, non-residential, fixed investment. Effectively showing you how much money are we putting into buying new stuff for corporations, right? Not the government, not households building homes, private in the sense of private corporations. So that's the public markets, that's the private markets. We were at a 9% reinvestment rate a year growth rate, which is a crazy level of investment. If you look at the beginning of the 1990s, we basically were at shrinking investment. But really kicking off with everything we saw from the dot-com boom, we saw this massive amount of investment. So what happens? So good, Joel. Yeah.
And just as a benchmark, I mean, for the economy, for any big segment of the economy to grow that much faster than the economy. So if you figure the U.S. Economy grows at 2.5% to even in a great year 3%, right? And yet investment was at a 9% per year investment rate. That was because of the PC and internet revolution and what tech was doing. It was really where tech started taking a much larger piece of the S&P 500 in terms of just market cap, right? And so when you looked at what was happening, there was good reason for it. There's good reason for it. That said, in 98, 99, you had this little hiccup that caused the Fed to say, even though we see all this growth in the economy and segments of the economy, we're still going to cut rates because they were generally concerned about the Asian financial contagion and that fall of long-term capital growth and other issues. So what Rob is saying is history, and what Rob likes to say is history doesn't repeat, but it does rhyme. And we're seeing an incredible rhyme between 94, all right, all the way to 2000, and what we're seeing now, where we're in the middle of an incredible industrial investment cycle with lowering rates. The net of all this is a bull market that's here to stay. We just may see some corrections along the way. By the way, Rob, 98, that would have been one of the greatest, that 35% drawdown would have been the greatest buying opportunities you could have had before the market shot up another 30 to 40% per year until things finally gave up, right, in 2000.
Right. Yeah, I mean, to your point, until what happened, literally everybody, and this is what happens, when you cut interest rates in front of an investment cycle, you are pouring jet fuel on top of the ability for companies that want to invest. And back then, the Y2K investment, the .com investment, laying of fiber optic cables, nobody cared about what was happening for all those things that I just talked about. Those things were irrelevant to that investment cycle, but the interest rate cuts helped fuel that. And that's what led to this explosion of the market higher from 100% upside that you would have been from the Netscape Navigator launch in 1994 to 600% upside in a year and a half. Now, of course, along the way, and this is what's important, there were 10% pullbacks, including that 135% pullback. But what you need to focus on is when you are in an environment where we are lightening interest rates, which is what we're doing right now, right? And also you have an investment cycle going, do not miss the opportunity for that 600% upside because of what you're seeing for, potential pullbacks. If we get one later this year, because we might get one later this year, who knows? Honestly, in terms of they can happen at 10%, 15% pullback can happen because of anything like, continued continued federal government shutdown or concerns about unemployment continuing to rise. But if that investment cycle is happening, pay attention because this is 98 and that light blue line is where we are if we start the exact same chart that we have from Netscape Navigator until the peak of the market in 2000. Well, if we just start a chart of the NASDAQ from when we released ChatGPT until today, and look at where that first and second rate cut are, we got a lot of potential ways to run on this tech adoption cycle. And by the way, from an investment cycle perspective, this cycle in terms of private non-residential investment looks an awful lot like it did in the 1990s. So are we going to be up 600%? Who knows? But do we have plenty of room to run? Absolutely. And so with that in mind, there's two companies. Yeah.
This bull market still has legs. That's the point of all this. And it's interesting that it's unemployment of college grads is heavily being, and particularly in the areas you mentioned, Rob, in terms of information and data processing and coding, is because of AI that is allowing companies to get a lot more efficient and productive. And so because of AI, right, and the boom in profitability that companies across the board are having from implementing AI, the true boom in profitability that we're seeing in measuring earnings across the board, you also have interest rates being cut because of that unemployment, which will only further fuel the boom in AI to continue in investment over the next 2, 3, 4, 5 years, right? It could go for a long period of time. So we are in the middle of a giant bull market. And Rob, there's a couple of stocks that I know you like that that should benefit from this.
Exactly. And so if we're going to have this investment cycle, what are the kind of companies that are going to win? And so we've got two that we want to give you all in terms of for context. The first is ASML. Right, ASML, one of the most important companies for making semiconductor chip equipment. If you want to make a lot of chips to power a lot of AI and the most complex chips from NVIDIA, you need ASML's chip equipment to make it. So these blue bars are what the company's real, true profitability are when we restate the statement of cash flows and we clean up the accounting noise. This is a company with really good profitability. Corporate average is around 12%. This company makes 20% a year. Wall Street, when we take Wall Street estimates and we push them through our uniform accounting framework and we clean up the noise and we say, what is Wall Street, not just from a revenue, but from all of the different parts of the forecast that we take for a company, what is Wall Street forecasting a company to do? Wall Street's forecasting ASML to see things get better, and the market is pricing in things to get a little better too. We think this company could have even stronger return on assets as this CapEx cycle continues to go underway that the market's not pricing in now. And similarly, United Rentals, URI, this company rents the equipment that you need if you're going to build data centers, power plants, semiconductor fabricators in the United States, all the stuff that you need, you're going to need to rent their equipment. Well, return on assets has been rising. We think Wall Street analysts are actually misunderstanding this company, expecting return on assets to drop the next 2 years. Because obviously we're going to get a big investment cycle, and the market is missing just how strong that investment cycle is. And so we think these are two interesting names. We've got a couple other names that we think are really, really interesting also. You can check them out at the New Energy Boom, newenergyboom.com. It's a special report that we've produced about one specific area that we're seeing this investment happen right now. And so if you want to actually learn more about the kind of companies that can win from this investment cycle that we are pouring lighter fluid on, check out that link and tune back to another Altimetry Authority show. We're going to keep on talking about this. And if you have any questions about this or about those companies, you want to see more companies like them, drop into the comments and come back for next time and hit that like and subscribe button. Thanks so much, everybody, and have a great day.
Thanks, everyone.